In our year-end 2017 video, we indicated investors can expect a lot more volatility in at least one 5 to 10% correction during 2018. This forecast proved to be accurate. Markets started the year on a torrid pace, with the S&P 500 index jumping 7% in the first 3 weeks of the year. This quickly came to an end as markets experienced a 10% correction in early February. So why has volatility returned to the markets after a 2+ year hiatus? In a word, uncertainty. Investors are uncertain about whether inflation is a risk because the economy is doing so well. Investors are uncertain about the possibility of a trade war between the United States and China. And lastly, investors are uncertain about companies such as Facebook and Amazon facing increased regulation. So how did all this uncertainty impact stocks? When the first quarter of 2018 came to an end, the S&P 500 index lost nearly 1%. Growth stocks continued the trend from last year by outperforming value stocks, as evidenced by large value stocks losing 2.8% in the first quarter, and large growth stocks gaining 1.4%. International shares lagged slightly, dropping 1.5% in the first quarter. Let's talk about bonds. Investors lost money in bonds during the first quarter of 2018. This has been a rare occurrence as the Federal Reserve has been lowering rates ever since the financial crisis of 2008. There is an inverse relationship between bond yields and bond prices. As yields go up, bond prices drop. The U.S. 10-year Treasury began the quarter with a yield of 2.4% and finished the quarter with a yield of 2.7%. Resulting in the largest quarterly rise since 2016. The Federal Reserve will attempt to boost interest rates in 2018, just enough to keep inflation under control without affecting the current economic expansion. This is a delicate balance, and any further signs of inflation will not be good for bond investors. It's that time in the video to communicate what we expect for stocks in the coming quarters, but we first must stress how important it is to ignore the headlines and stick to a plan regarding your investments. Investors get emotional in times of high stock price volatility and discard their well thought out strategies. Don't panic or get emotional when it comes to your investments, as this usually leads to very poor decision making. In our opinion, valuations don't cause bear markets. Rather, euphoria followed by recessions do cause bear markets, and there are no signs of recession on the horizon. The upcoming earnings season is expected to be strong, as it will be the first set of earnings incorporating new tax cuts. Strong corporate earnings will likely get investors back to focusing on fundamentals such as earnings, dividends, and stock buybacks rather than headlines. As a result, we expect the market to recover in the coming months and continue on an upward trend. Our forecast for the S&P 500 index remains for gains between 6 and 12% in 2018. From the HM Capital Management team, thank you for watching.